Bloomberg Audio Studios. Podcasts, radio, news.
Meta is said to have selected Pimco to help lead a $29 billion financing for its data center expansion. I'm happy to say the Pimco CEO, Manny Roman, joins us now for more. Manny, good morning.
Good morning, Jonathan. Nice to see you.
It's good to see you, sir. How does a man like you deal with a 3 a.m. alarm clock on the West Coast? How does that work? You've got
I make the best espresso known to mankind, and you'll be happy.
Triple espresso?
Triple espresso. And it feels good every day and happy to be at work.
Well, I'm happy to have you with us this morning. Let's get into some of these deals. I know there's certain deals you can talk about, can't talk about. I want to talk in broad terms about the appetite here. For the capital that we need to provide to this particular force, this growing force, AI data centers, where it's going to come from, and where you and the team are going to fit in.
So I think it's a huge, super secular opportunity. There is an enormous need for funding and equity in data center. I don't know whether the $6.7 trillion from McKinsey is remotely right, but it's very, very big, and there'll be plenty of financing deals to be done, and there'll be plenty of construction to be done. And it's true in the US, but it's true in other parts of the world. And the need also to have the infrastructure and the energy will come after that. So, we all talk about data center, but there's going to be a real rush for energy in terms of providing the right setup for all this data center. And, that's one of the reasons to be very bullish on natural gas.
We've reflected on one particular statement from one particular tech CEO over the last 12 months that I think was really quite important. It was last summer. It was the Alphabet CEO, when essentially he said that the greatest risk here was underinvesting and not overinvesting. And I wonder how you think about that from the perspective as an asset manager, when you've got a group of companies that are willing to run the risk of overinvesting. How do you think about the risk around it?
In terms of, I think what we will do is we will look at every single deal and we will say this makes sense for us and this may make less sense. And I think one of the strengths we have is to be pretty focused on relative value and sort of think that there may be a fantastic deal to be done, which will be very, very good for our investors. And then we'll look at the next one in the full light of day and decide whether it fits our portfolio and whether this is something we want to do.
I think it's important to build on this, that Mark Rowan said recently, we are what we originate. When it comes to private markets, you are what you originate. It's quite labor intensive. It takes a lot of work. When you think about scaling this and building this as an opportunity, how difficult is it in practice?
I think we have built it differently from Mark. We have built it based on our experience in fixed income, our experience in relative value, in a history of 54 years, in looking at all sorts of credit. We have 55 credit analysts who looks at every single segment of the market. And I think we look at it from a value standpoint. Does it make sense? Is it something we want to do? We shouldn't be originating for the sake of originating. And there's a lot of money coming to this market. Some sectors will be very attractive and some will be less so. And I think you want to be very much on top of this and say, I want to do this and I want to do less of this.
There's a concern, especially as CEOs say, it's more important to be throwing enough money at this rather than being underinvested. And then you have people like David Einhorn of Greenlight coming out and saying the numbers that are being thrown around are so extreme that it's really, really hard to understand them. How difficult is it to invest in a market where people are throwing spaghetti at the wall to try to understand what's going to stick? And there is a feeling of excess that continues to bubble up around this.
So my friend Richard Thaler, who is an economic Nobel Prize and consult for us, has this say. He says, when you make long-term prediction, the degree of humidity and the standard deviation around the estimate should be very, very big. So when I hear an estimate like $6.7 trillion, I don't know what to make of it. David may very well be right, but we'll take it one step at a time. I think 6 months horizon is about all we can do in terms of the demand. And then, the environment may change dramatically. There are business cycles. Sometimes things are cheap. Sometimes they're expensive. If there's a recession, all of a sudden spreads will widen. Company may revisit what they're trying to do, and so on and so forth.
So this is the difficulty. How do you have a 6-month horizon when a lot of these investments are 10-year build-outs, when they're 10-year usage, when they are labor-intensive, and infrastructure projects by nature are a lot longer than 6 months? So
in terms of committing capital and in terms of finding the right opportunity with the right length of time, we're totally fine to have a very long-term horizon. What I'm saying is making long-term prediction in terms of how big the market will be, it's very hard. I think you have some some visibility over the next 6 months in terms of what the demand is, what the real demand is, and whether that slows down or whether that accelerates. You just don't know. And I think you have to be very humble about these things and just say, look, we'll take it one step at a time and see what the market gives us. And by the way, there may be other opportunities which are more attractive. You look, for example, in our asset-backed finance business, aircraft leasing. Aircraft leasing is incredibly interesting, and then nothing happens for 5 years, and then it becomes very interesting again. And you gotta constantly say to yourself, are there better opportunities for me to deploy money? And what do I want to do? How do I think about the risk? How will I get out? What's the right risk-return profile?
You made a headline recently. Wanted to ask you about it. Private markets haven't been tested. Can you build that out a little bit more? What did you mean when you said that private markets haven't been tested?
Well, my partner, Dan Iverson, and our CIO of Core, Mohit Mittal, have the charts. And we checked the number about 20 times because we kind of didn't believe it. But it shows the return on weak single B, which is a reasonably good proxy for direct lending. And what you see is you make money because the yield is higher, and then there's a recession, and then you lose it all. And so I'm old enough to remember 1991. I saw that. There's a recession which came out of nowhere from, essentially SNL having too much high yield. 1997. The world is absolutely fine until there's an Asian crisis, and then you have LTCM, and then things become very cheap. And so you got to remember these things. And we have been in a period since 2009 of exceptionalism, where you have had very strong equity return and very strong high yield return. If you believe this is gonna continue for the next 15 years, then I think you should have the same position. But it may not be the case. And I think we bring that and say the data's at the data.
Do you see parallels between now and those periods?
Well, I think the initial condition where we are right now are such that equity markets are expensive by any measure. They may go higher because momentum is strong, and credit market are tight in some part of the spectrum. And I think that's the reality. And look, we've been in a period where things are expensive for a long time. 2005, 2006 were such period where things remain expensive and became more expensive, and then something breaks, and then all of a sudden you have a lot of work to be done.
Manny, let's continue the conversation we were having. Equity markets very close to all-time highs, credit spreads near multi-decade tights on investment grade, high yield spreads near the tights of the year. And yet we've got a Fed official saying that we're excessively restrictive. You're across a range of funds. You look across markets all the time and the economy with the team. Do you see any signs that we're excessively restrictive?
Well, I think rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. And we talk here about the US, but look at the UK. The UK, where you're from, is 10-year rates are 4.75. Australia looks really, really attractive. So when we think about the opportunity in a way, yes, we do expect the Fed to cut. How much they're going to cut next year remains to be proven. No one knows what's going to happen to the labor market, but the reality is the opportunity in terms of global fixed income is very, very big, and the opportunity to add alpha is quite high. I'll tell you a funny story. We have a partner in Tokyo called Tomoya Masano, and for the longest time there's not much happening in Tokyo. So you sort of call him and you have matcha with him, and not much is happening. And then all of a sudden the Japanese fixed income market becomes super exciting, and then there's a lot to do. And there's a whole generation of people who have disappeared because they don't do it anymore. And so you have a labor market which hasn't supplied fixed income investor because there was nothing to do for the longest time. And so what I think is interesting is the difference of view, the difference of opinion is also a source of incredible alpha. And if you want to think about why performance has been quite good, it's partially because the alpha that is being given by the market is quite good.
I think it's interesting that John was talking about the Fed and you talk about the international sphere. And I think that that's really telling about what people are looking to for that alpha, for that incremental extra yield. Are those Japanese investors staying in Japan right now and not coming to the U.S. for treasuries, even if the Fed cuts?
No, I think they're very big investors in U.S. assets. And remember, one of the opportunity everyone has is to buy foreign assets and swap them back into dollars or swap them back into yen and so on and so forth. And so you can actually buy synthetic credit, you can buy synthetic dollar exposure for U.S. investors buying, for example, JGB and selling forward the yen into dollar and having a different credit risk with JGB than you have with US dollar. And so there's a lot to do. Now, we do that a lot in short term and longer term in terms of adding alpha, but all the time you can do this sort of transaction and sort of mitigate your exposure or increase your exposure or have different risk profile.
That's a much smarter way of looking at it. I'm looking at this with sort of a blunt instrument, sort of dumb. Do you like international more than the United States?
But I mean,
and you come up with this really wonderful, nuanced view.
Japan has an enormous amount of money to put to work and is a nation of savers. And so the thing that I always say is you need to put your money somewhere. And the reality is the US is the only place where you can actually put scale. And when you want to think, for example, of the Australian problem, there was a whole delegation last week from the UN from Australia. They need to move capital away from Australia because they are a nation of savers and the Australian market is not big enough for them, and so they need to pivot too.
For a long time, Japan had to do the same thing. They didn't have the yield. To your point, the story's changed. One thing we're trying to track is whether the Japanese bring the money home, whether we see this great repatriation where it could leave markets vulnerable, where typically they deploy that capital. I'm thinking of certain European markets, the US as well. Are you seeing any of that flow story start to turn?
No, not so far.
Would you expect it to change?
Honestly, not really. These things are very, very slow to move. And the reality is people keep on saving in Japan. And so it may just be that the marginal dollar goes into JGB, but the credit markets are very underdeveloped. And if you want to buy, for example, single A exposure, you're much better off going to the US.
The conversation we had back in April was maybe the decline of US exceptionalism. The money was going to leave, it was going to go elsewhere. I want to understand where you are now 6 months later. What did you see at the time in April? Did we start to see that decay click into US exceptionalism? And are we back to where we were at the start of the year just 6 months later?
So I think we were dollar underweighted. We literally just square off our position. We still very much like emerging market currency. We do like Australian dollars. There's plenty to do, but there was a short dollar position to be had. And, it moved 10%, and I think we decided to square our position.
You're talking a lot about rates and the era of income. We've been talking a lot about that just based on the fact that yield has been higher. We're talking about private investments through infrastructure. You're not mentioning equities. And this is a time when people are talking about...
I'm a fixed income guy.
No, I know, and where you have sympathy with us. But I'm wondering how much a higher rate regime limits future equity returns. We used to talk about that. That was before 3 years consecutive 20+% returns. I mean, at what point will it constrain the equity side of the portfolio, even though some people are wondering what kind of buffer bonds really provide?
Well, the Pimco view is that equity return in the US is going to be 6% for the next 3 years or something like this. I mean, we look at CAPE valuation, it's trading at 28 times earnings. It looks really, really high to us. We understand the excitement about the hyperscaler. But if you look outside of the hyperscaler, life in industrial America isn't great. I mean, top line is not growing. And one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin and so on and so forth. And we don't know that. And so there's a whole leg of the equation that we haven't really seen.
Stock investors have been trying to outbull each other this morning, and Max Kettner was on earlier of HSBC, and he was saying, look, he thinks that the Fed is making a policy error by cutting more significantly, but they're along for the ride because it's just going to inflate the prices of assets significantly. They want to gain from that. Do you agree with that assessment?
Well, I haven't listened to him, so I would not be.
Good initial punt. I mean, do you think? Yeah.
I don't know. We have a lot of trust in the Fed in terms of them doing the right thing, and I think that the Fed usually doesn't know much more than we all do. They look at the same data, and so the decision is a very well thought out decision where they will decide what to do with the condition that they are being given. And if, for example, we were to see a very bad inflation print, it would be very difficult for them to cut. Now, they may argue that they have to look through inflation and so on and so forth, but The Fed is a very rational actor in the market, and I don't think anything's going to change. And the same goes for the central bank in the UK and the ECB and so on and so forth. And I think once you're in a job, your behavior changes also in terms of how you think about what the right thing to do is.
Are you alluding to the new Fed chair next year when you say that?
I'm just saying it's like being a Supreme Court justice. It's a very important job, and I think people take their job very seriously.
There could be a big change next year. There's going to be a new Fed chair. Do you expect to see any daylight between a Fed chair appointed by this White House and Chairman Jay Powell and his current leadership?
I was reflecting on this, and we were talking about this. I mean, every single Fed chair has been, to some degree, a political appointee. And, there's been a history of very good Fed chair since the Burns and the Nixon presidency. And I see no reason why that would change.
The list of candidates we've seen so far, we've said it repeatedly, very credible names on that list from this White House and the Treasury.
Yeah. And it is important to remember that it's in everyone's incentive to have a very credible Fed chair, because the market will not like a non-credible Fed chair.
You're running?
I was going to say
you fancy
the same
it?
thing.
No. You're happy on the West Coast, right?
He didn't answer, so that means yes. He's confirmed.
I don't think Manny wants that job.
Manny, it's good to see you. Thank you, sir.
Good to see you. Thank you for having me.
We'll do this in Newport next time, okay?
Absolutely.
When the weather starts to warm up a little bit around spring.
Or when it's very cold in New York City.
Either. Really? Winter turn of the year works for me.
Vacation?
January time.
Play golf.
Yeah, we'll try and make that happen. All right. Manny, thank you, sir. Appreciate it. Manny Roman there, the Pimco CEO.